All right, let's jump right into today's explainer. We're tackling a massive, multi-billion-dollar mystery surrounding a company that literally touches almost every single aspect of digital life. You already know Tencent is an absolute behemoth, right? I mean, from gaming and WeChat to digital payments and cloud computing, their global reach is just staggering. But here's the crazy part. Despite having these incredibly strong underlying businesses, their stock is currently trading around 23% below its 52-week high. So what exactly is going on under the hood here?
Well, you've got to see this glaring paradox from their August 2026 earnings report. Revenue is jumping significantly. It's up 11% year over year, hitting 204.8 billion RMB. That is a seriously healthy top line. But then look at the net profits. They just entirely flatlined, growing a meager 0.7% to 56 billion RMB, totally missing analyst expectations. So where is all that extra revenue actually going?
And this hits the nail on the head regarding the exact dilemma the market is wrestling with right now. It really frames the stakes for our whole explainer today. Are we watching Tencent quietly lay the groundwork to become China's undisputed next-generation AI giant? Or, in this frantic rush to knock it left behind, are they just throwing vast amounts of cash into an experimental black hole?
Let's dive right into part one. The culprit, the enormous AI gamble. To solve the mystery of this missing profit growth, we have to follow the money. Just look at the sheer, breathtaking scale of this number, 52.8 billion RMB. That was Tencent's capital expenditure in the second quarter alone. To put that in perspective, just one quarter prior, that number was 31.9 billion. This explosive acceleration in spending proves without a doubt that Tencent is aggressively, maybe even frantically, building out its AI infrastructure. But here's the crucial point. This 52.8 billion isn't just some theoretical research spending. They are actively deploying a massive suite of real-world AI tools. We're talking about Yuanbao, Hunyuan AI, and enterprise tools like WorkBuddy. They're infusing AI directly into their advertising, their cloud infrastructure, and their massive gaming footprint. And just this August, they initiated the global launch of their updated Hi3 AI model. So this deployment, it is happening worldwide right now. Moving on to part two, the engines, funding the AI arms race. Now, you might be wondering, how on earth is Tencent affording a 52.8 billion RMB gamble without completely wrecking their balance sheet? Well, it comes down to a very clear pipeline, which basically forms the ultimate bull thesis for the company. It goes like this. Step one, their traditional stronghold, gaming, generates massive, consistent cash flow. Step two, instead of just sitting on that cash, they funnel it straight into this aggressive AI investment. And step three, that AI investment cycles back to improve their other highly profitable segments, like advertising and cloud. It's essentially an ecosystem feeding itself. And we can literally see this ecosystem working perfectly in the Q2 numbers. These core cash engines are incredibly healthy. Gaming brought in 98.4 billion RMB, growing at 8%. Fintech and business services generated 60.3 billion, growing at 9%, and marketing services pulled in 43.6 billion, skyrocketing by 22%. These legacy segments are pumping vital, sustainable capital into the system to keep the whole AI machine moving. I want to pause right here for a second, because this is a highly critical clue from the source material. Remember that 22% jump in marketing services we just talked about? That growth is being heavily driven by AI-driven improvements in advertising. This proves they aren't just spending on AI. They are already successfully monetizing it. The tech is actively making their ad targeting more effective and more profitable today. And this brilliantly illustrates why Tencent is positioned so differently from others in the AI space. You know, if you're a pure high-risk AI startup, you basically live and die by your next model. But Tencent is deeply diversified. They have multiple lucrative sectors acting as a financial safety net. If an AI product that's delayed, no problem. The gaming and fintech divisions keep the lights on and the cash flowing. All right, part three, the valuation debate. Cheap or a value trap? Now that we know where the money is going and how it's being generated, we have to ask, at around $58 a share on the OTC market, are we looking at a hidden gem or a value trap? Historically, if you look from 2021 through 2025, you see a story of really steady recovery. Following a dip in 2022, revenue just marches upward. Earnings recovered strongly by 2024 and 2025, and the dividend per share steadily climbs every single year. The business has been fundamentally sound. But remember, 2026 introduces that massive new variable, the exploding AI capital expenditure we talked about earlier. So, how is the market pricing that new AI variable today? Well, the contrast is honestly pretty stark. Back in 2023, investors were perfectly willing to pay 21.6 times earnings for Tencent. In 2024, it was 18.4 times. Currently, in late 2026, it's trading at a relatively low PE of just 15.09. So, on paper, the stock appears considerably cheaper right now than it has in recent years.
And that brings us to the ultimate clash of perspectives. The bull view looks at that cheap valuation and says, look, this massive AI investment will create substantially higher revenue tomorrow. We got to get in now. But the bear view looks at the exact same data and counters with, yeah, but what if the AI monetization doesn't justify this enormous capital spending? The bears are worried it's just a drain on today's free cash flow, which, by the way, currently sits at a very strong $26.53 billion over the trailing 12 months. Ultimately, the AI capex is the wild card here.
Let's move to part 4, the threat matrix, high-stakes market risks.
To really evaluate that wild card, we need to step outside of Tencent's own balance sheet for a minute and look at the very real external threats that could completely derail these ambitions. The source analysis outlines 6 core operational risks. First, that exploding AI capex failing to monetize. Second, operating within strict Chinese tech regulations, which, as we know, can pivot rapidly. Third, the highly complex US-China geopolitical situation. Fourth, fierce and expensive competition from domestic rivals like Alibaba and ByteDance. Fifth, any potential changes to gaming regulations, which would obviously hurt their core cash engine. And sixth, the structural risks of trading OTC and dealing with currency fluctuations.
And hey, that geopolitical risk? It isn't just theory, it is directly impacting operations right now. Due to current US-China semiconductor restriction policies, Tencent is receiving limited shipments of NVIDIA's advanced H200 AI chips. This restricted access directly affects their ability to get the raw, cutting-edge computing hardware they absolutely need to train models and compete at the highest level globally.
Which brings us to part 5, the final investor verdict.
Okay, so we've got incredibly strong core businesses funding massive AI spending, a cheaper than usual valuation, and a complex web of external risks. Bringing all these clues together, the source material makes one thing very clear. You don't sell simply because the stock drops 5% on some random market noise. You watch the fundamentals. These are your real red flags. Sell or reduce if that AI spending keeps exploding but fails to generate real revenue. Sell if free cash flow structurally weakens, or if those core cash engines, like gaming and advertising, show material decline. And of course, keep a very close eye out for any significant intensification in regulatory restrictions. On the flip side, here's what you're looking for to justify a buy or hold. The source actually gives Tencent an 8.5 out of 10 fundamental score. This suggests accumulation if the stock remains around its current $58 level, or if it corrects further during broader market weakness. The thesis holds together beautifully if AI continues producing measurable revenue, the core businesses remain robust, free cash flow stabilizes, and the valuation stays historically reasonable.
And this brings us to our final thought. If there is absolutely nothing else you take away from this explainer, let it be this one formula. AI capex must lead to AI revenue, which must ultimately lead to free cash flow. Tencent is taking an enormous, multi-billion-dollar gamble on the future, and they certainly have the ecosystem to support it. But will they successfully execute this specific equation to become the ultimate AI powerhouse? Or will this go down as the world's most expensive misstep? Thanks for joining me today, Focus Learners. Keep exploring, and I'll catch you on the next one.